There are a number of things that determine mortgage interest rates. They may be any combination of the following: rate of inflation, the jobs market, geopolitical activity, political agendas, global factors. There's also the secondary mortgage markets, as well as the federal funds rate. Hey guys, Realtor Adele, your favorite realtor and investment property strategist. In this video, I break down how mortgage rates are determined. Hopefully by the end of it, you will have a full understanding of why mortgage interest rates fluctuate and the reasons behind it all. Let's begin. Inflation is the cost of goods and services that tends to dictate or guide purchasing power within that ecosystem. If inflation is high, mortgage interest rates tend to follow. The job market tracks labor and employment statistics within various industries. Not only does it track the unemployment rate, it's broken down by industry and shows which sectors have strong or weakened unemployment rates or retention within a given period. Geopolitics refers to the relationships between countries. The nuances of each country's politics, their individual economies, the goods and services they provide through trade and barter and or treaties. All of these tend to trickle down and impact mortgage interest rates. In regard to political agendas, be it state or federal, these tend to include particular issues or line items that the government want to address or solve. Global factors tend to include issues such as the health crisis in 2020 and wars or threats of wars and other tensions that tend to impact global and local economics. The health of the economy is really the be-all, end-all of how mortgage rates are determined. It's really the beginning and end of it all, right? Everything I previously mentioned impacts the economy in some way. Let's reflect briefly on the health crisis. Initially, during the shutdown, rates were lowered to encourage the flow of money and jobs. It was quickly realized that housing was the proverbial ticket to keep the economy moving forward, since home would become where we all existed about 90% of the time, at least for the foreseeable future. Hence began mass migration. People wanted bigger or more practical homes customized to both their personal and professional lives. The inflation on goods were almost immediate, followed by services, which includes the buying and selling of homes. Mortgage rates skyrocketed along with home prices. The hike in rates were partially to slow inflation by making home ownership unaffordable. It's an ironic catch-22, a lot of back and forth as far as the numbers are concerned. Fast forward to current day, thankfully, the health crisis is no longer the focus. However, a spike in the cost of goods and services remain. The rate of inflation will always impact mortgage interest rates along with the general health of the economy. Secondary mortgage markets involves the selling of mortgage loans and or the servicing of these loans. The majority of homeowners experience this firsthand. When you buy a home, you may start off paying your mortgage to the lender that issued your home loan. At some point, you receive notice that moving forward, you will pay your mortgage to a different company. That means that the second company purchased your loan or the servicing of it on the secondary mortgage market. This is not unusual practice since lenders on the primary market want to free up funds that they extended to consumers to buy a home. Basically, the monies that were initially borrowed for the home purchase is recycled or returned to the primary lender, by being purchased on the secondary mortgage market. This allows for the primary lender to fund more mortgages. The federal funds rate is the rate that banks charge each other for extending temporary funds. Contrary to a bit of popular belief, the Federal Reserve does not set or determine mortgage interest rates. Mortgage interest rates do tend to follow the direction of the 10-year Treasury yield. In a high inflationary environment, we will see evidence of this as rates tend to increase repeatedly in an effort to slow down inflation. Mortgage interest rates can be very unpredictable. There are many moving parts. It all boils down to not just what's going on locally, global issues also play a significant role as well. At the end of the day, the higher the risk from a financial standpoint, the higher the cost to borrow money. So although there's no predicting of mortgage interest rates, thanks to data and a general understanding of how the economy is trending, we are able to understand why mortgage interest rates are what they are at any given period. As always, it's my goal to provide you with accurate information from trusted sources so that you can make the best decisions for yourself and your family. If you found value in anything I've shared, please share this video with others whom you feel may find value in it as well. Also, give this video a thumbs up, subscribe to the channel, activate the notification bell so you don't miss out on future videos. I truly appreciate your support. That's all for now. I'll see you on the next one.